I've had a little thesis in running the Center for Civil Society in Durban. The thesis is that there are some NGOs that are inside the box, and their ideas are stuck inside the box. And if the NGOs happen to be headquartered in Washington, or even with our dearest friends from OSISA, who happen to have financiers based in New York, that box is capitalism. Is that right? That capitalism is the box. You dare not go outside that box. I want to do a little bit of stretching the box. Is that okay? The box is basically property rights. And property rights, to me, are part of what Tendai and Keke said have begun to limit the possibility of Africa's development. Under neoliberalism, where in prior eras, states could impinge upon property rights. Under Keynesian, social democratic, northern experiences, or under the so-called socialist. I'm not sure the workers ever controlled the means of production, but whatever you want to call them. And then especially under the nationalist governments that had high growth in the 60s and 70s, and many of them then ended up with corrupt elites who took those forces. Because I think especially the latest data, I'm talking about data just hot off the press, six weeks old data that come from UNCTAD, they'll augment what we're going to be talking about with Leonce Ndikumana and James Boyce and GFI. You're going to hear much more about this huge problem, especially in the 2000s with the commodity price boom, and especially where these commodities, metals, oil, natural gas, minerals, are the core of our problem of outflows. And we've got Sarah Bracky and Khadija Sharif to tell us, case study-wise, in an Oxfam-supported project of De Beers. I won't dwell on these because we have the experts here. We have the Thabo Mbeki study that civil society has broadly endorsed. But I think outside the box, outside illicit, we should look at FDI, and we should do it with two thoughts in mind. One is that their profits, dividends, and outflows, even aside from trade misinvoicing, aside from all the corruption and all the illicit stealth, there's actually legal profit, dividend, and interest outflows, but also there's natural capital. Those two things, it strikes me, might be outside the box, but let's see if we can get the box to open up a little bit more, because it's a critical moment. The brand new June 2015 UNCTAD report, they do this every year, the investment report, shows that FDI is crashing. You can see it. Again, I'll send you these so you can really look. But 2014 is 16.3% crash, and we've had crashes since the 2008 crisis of 20.4%, 2009 as well, 2012 a crash. It reflects that the world economy has been terribly stagnant, but this isn't brand new. This is we'll look at as a long-term trend. That the commodity price crash has been devastating since 2011, especially mid-2014. That the foreseeable conditions for more FDI in Africa are pretty miserable under these circumstances. And then you'd kind of ask, well, if that's part of the problem, maybe we'll see Africa thriving. Partly if we see something called a gated globe, and I'll end with this idea that we can actually put some brakes on FDI. FDI to me isn't something that you should ordinarily seek. I'm going to make the argument you should avoid FDI. You should do what Keke said, make your investment nationally based. And this is what's happening around the world with new national investment policies that are restrictive to FDI. And The Economist calls this trend the gated globe. This is a couple of years old, but it's a very important trend, especially because it comes in the context where neoliberalism and global capitalism have failed us. It's been stagnant. Don't take it from me. This is a World Bank report on the decline in per capita GDP. You see in the 2000s, we've seen pretty miserable 1%, but even before that, going back to the 70s, the decline from 3.6% average GDP per capita growth in the 60s, down to 2.1 in the 70s, 1.3 in the 80s. You know, we've got long-term 40, 50-year stagnation. Leonce's got a group around Amherst that call this the long-term overaccumulation of crisis. And if you do the update, this is Michael Roberts' graph, you'll see that it just continues into the last couple of years as well with that big crash of 2009. And we've been hard hit in our region with, aside from Botswana, all the other major economies crashing. And that was after that big boom in commodity prices. Remember 2002 to 2008, a crash, and then it resumed growth to 2011. And let's take South Africa's main ones. Platinum's down quite a bit now, but I mean, I look at coal from KwaZulu-Natal, and it was at $165 a ton in, $145 a ton in 2011, and by 2014 down to $65 a ton. So, and hopefully it'll keep going further. I mean, we need to save the climate. That means hopefully coal won't be profitable anymore. It's the poorer countries that have been the so-called beneficiaries of FDI. I think that explains the persistence of poverty. This is a contested debate. It's the profits, the outflow of profits, dividends, and interest you can see from multinationals that I'm going to be targeting. But it's not just in the extractive industries. Just as Kekya said, it's this new PPPs. This is a brand new report from Eurodad that the Financial Mail covered this week. 7 to 8% effective interest rate, double government borrowing costs, 24% added markup on a PPP-funded road. How many of you came here on a toll road? If you went to the Joburg airport, you certainly did, right? That notorious e-tolling of Gauteng that the society's up in arms about. And I think you're in Zimbabwe getting some Development Bank of Southern Africa PPPs, right? Those are ridiculous markups. I think everyone would agree. How about this hospital in Lesotho? This is a notorious case Oxfam investigated. $67 million a year cost of a PPP hospital, 3 times what the old one cost, right? 55% of PPPs get renegotiated, and 62% of those result in higher tariffs. 15 to 20% of infrastructure is funded with private finance. These are some very dangerous trends, added to which are the portfolio. These are the financial flows, and I'm not going to address them now. This is the in and out flow of hot money, of financiers looking for bonds, securities, stocks, and you can see the effect, the correlation to the exchange rate, especially, of these inflows and outflows. I'll leave those aside because it's really the FDI that I'm interested in now, and especially because we've been seeing much more of Southern Africa getting nailed by these outflows of profits, dividends, and interest. This is from the new UNCTAD report. I'll send you the details. And I'm quite worried that mining is making a bit of a comeback on the FDI. South Africa's had a massive outflow. This is reflecting, I think, something we've witnessed since 2000. Why 2000? 2000 is when, okay, let's say the Thabo Mbeki Institute personnel are here. What happened? Did you guys have a president who allowed our biggest companies, right? Which ones? Anglo-American, De Beers, Old Mutual, SAB Millard. You were misled. Okay, Wusi knows that he's speaking truth in hindsight, and that was the biggest looting. I mean, I don't know if it was part of the transition deal. I'd love to hear whether President Mbeki would agree that the white guys said, okay, we'll give up apartheid, but you let us keep the apartheid loot. Oh yeah, let us take it out of South Africa forever. And that's really what's happened. And you see the red line going down is our current account deficit. My friends, this is the profits, dividends, interest outflow. This is disastrous, right? Because in order to pay those, we have to borrow hard currency because we're not really exporting very much. So we have this huge foreign debt emerging. Do you see our foreign debt? It's now $145 billion. President Mandela inherited $25 billion from apartheid. And the danger here, as the Reserve Bank has said, is we're now, in terms of our economic ratios, that foreign debt for South Africa is as high as it was when this terrible old guy, who remembers him, P.W. Botha, he made this thing called the Rubicon speech in 1985 in Durban City Hall. Remember, do not push us too far. And when that happened, the banks ran, and he had to declare a debt crisis. He closed the stock market, and by desperation, he did something I want to argue we should all argue for. He put on exchange controls. Those were taken off by Mandela, by the way, in 1995. It was called a FinRand, the financial rand. But I think this is critical to the argument. I'm not the only one. Big companies taking capital out of South Africa are a bigger threat to economic freedom than Juju. Uh-oh. Okay, that's really bad. Okay, that's in South Africa, you guys know. Okay, that's as bad as it gets. And it is a problem with our brand new data that comes from the first quarter of 2015 FDI outflows. But here's what I just picked up in the Reserve Bank quarterly about 6 weeks ago. a fascinating new development, which is these profit dividend interest outflows, especially dividends. Dividends are measured by the profits that go to the home company, right? And South Africa, unlike, say, US, Netherlands, who are getting 200% more in inflows of dividends, profits coming to the home-based multinational, than they are in spending outflows. So double the inflow compared to the outflow. Well, South Africa was, in the 2009 to 11 period, only getting a third. Here you've got an interesting ranking, right, of imperialism and what I'd call sub-imperialism. The US, Netherlands, Sweden, France, UK, some of the big European imperialist companies, Japan would be up there. And then the sub-imperialists get sort of less than half back than what they're giving out to multinationals. And then you get the very poor countries, Indonesia, Philippines, just getting totally looted. But this is interesting. They just did the update. And from 2012 to 14, South Africa's went up to 45. I think that means, I'm not 100% sure, but we're looking into doing some studies, that South African capital is looting Africa much more rapidly the last 2 or 3 years. So we'll look back at that maybe. It reminds me of this old map. What happened in this place? This is bad, right? This is Berlin, 1885, when Africa was carved. And this is one of the most interesting questions. Is there a new scramble? This is what they call the scramble for Africa. 5 big countries, Britain, France, Belgium, Portugal, Germany. 130-year contestation. And now we've got BRICS, 5 big countries, that are against this legacy of colonialism, of neocolonialism, of neoliberalism, right? This disgusting picture. It's appalling. BRICS is against this, right? Or is it within it? Oh, man. They just want a seat at the table? This is the new scramble, right? And that's why this profit dividend interest outflow is going to be a really big challenge, because we've been having some NGOs with rhetoric, even some leftists, some third worldists saying, oh, great, these goddamn Western exploiters. Now we've got friends. Okay, I heard you say that once, my dear friend Claude. Our friends from China, they're different, right? Well, what they all want is pretty similar. This is the useful Africa, right? This is the resources. Our minerals down here, this big chunk, this is really important, right? This is the PMG, the platinum group minerals. Okay, and you have some in Zimbabwe as well, and some diamonds and things. So you can go through and look at these. This is where, especially with adding oil and gas, I can give you that graph as well. This is where Africa's rising. Is that right? Of course it is, because just as you said, Tendai, it was the old economists saying Africa's hopeless, right? Has been replaced by the new economist with this lovely kite and then the Time magazine. And you can track, as I did with Google, how many times this phrase has come up. Have you ever heard this phrase, Africa rising? Of course you have, right? And this is why, it's GDP. GDP has been going up. So they can show that average gross domestic product is going up. This is the orthodox understanding. And indeed, because there are so many limits to GDP, we have a Gaborone Declaration. Is this something all of you've picked up on? I really wish the NGOs and the funders in the room, and the researchers especially, really look at this. It's not very complicated. It says, because they're recognizing limitations of GDP as a measure of well-being and sustainable growth. So it's terribly limited, GDP. What we should do is integrate the value of natural capital into national accounting and corporate planning. And there are 10 countries, and there are several heads of state that Ian Kama and the World Bank and Conservation International invited in 2012. The World Bank has a whole big project called WAVES, and they're trying to do this measurement around the world. Now, I have some very grave reservations about neoliberalized nature, counting as if you want to put it to the market. But I do think we should understand the counting, because if we can say we're not measuring in GDP the resource depletion, our natural capital, we pull it out of the ground, we pull those Marange diamonds and that Marikana platinum and our KwaZulu-Natal or Limpopo or Mpumalanga coal, and that's extractivism. That's the depletion of non-renewable resources. Air, water, noise pollution, farmlands, unpaid women's community work, of course, family breakdown, other social values, and crime, IFFs. These are not measured. So we need a genuine progress indicator that says GDP is not actually rising because we have to correct what economists value for what society values, and for what environmentalists value, and what women value. So I'll just take one of these, resource depletion. And again, don't take it from me. I'm just some kind of, Marxist based at KwaZulu-Natal and now a little bit at WITS. Let's look at the World Bank. So they've got 4 adjustments. And you can see the main one is the natural capital depletion, right? That's the depleted natural resources. So they can correct GDP. They give you a little credit for education, but you depreciate fixed capital, wear and tear, and pollution. And you can update this. The little green data book comes out every year from the World Bank. So you can go through each country. Each of the places that you work are in this data book, and you'll see this terrible change. And 88% of Africa's countries are suffering depleting natural capital, right? This is the overview, and very few can actually come out of this stat and say, actually, yeah, we are still rising. South Africa, for example, our natural capital stock, about $5,700 per person, and 9% of income depletion from particularly coal and platinum and gold. And that means per person, we go to sleep on December 31, New Year's night, right? And wake up January 1, and we go to work that year, and what do we get? We get $245 of natural capital plus other declines in our wealth. What? Each year we're growing $245 poorer per person in South Africa. We shouldn't get up and go to work. We should stay in bed that year. Okay, it's bad, right? This is the industrial powerhouse of the continent. And we're getting resource cursed at this level, right? And Africa is getting completely screwed and looted compared to the other parts. And it's going to even be more so because of PIDA, right? The Program for Infrastructure Development in Africa is all about this extractivism. It's going to shrink our natural capital, our communities, our economies. And we're celebrating, oh, great, PIDA, and the BRICS New Development Bank will fund infrastructure. We'll have 1 trillion rand of nuclear energy to make it all click in South Africa. So when you see Africa rising, just take this graph. This is the output once you correct for natural capital, right? You can't just add the depletion of your natural capital as a credit on GDP. You've lost your assets. The wealth has shrunk. So you do that correction. Africa's rising? No, come on. Who's scamming us on this? So what's rising? The middle class. Okay, I know there's one representative formerly of the African Development Bank here. But what were they scamming us on, Leonce? Telling us there's a middle class, eh? That wasn't you, okay. Now, this is ridiculous. $2 a day is your middle class? Okay, so when you actually look at $20, a whole presentation against that. So what's really rising? We know what's rising. The profits of the extractive industries. Africa's not rising. The middle class isn't rising. It's multinational corporate profits. And it's also one other thing, because I've just got 4 minutes left, so I can celebrate the way Tendai wants by saying Africans are uprising against Africa rising. Again, don't take it from me. This is Agence France Presse. I think mandated by the African Development Bank. Is that right? Yes, this is the African Development Bank, African Economic Outlook. And, okay, of course you're going to get a tick up in 2011. That's North Africa. That's great. Well, okay, Tunisia was great. The others we don't want to talk about. But the other protests continued. Okay, what happened here? Who's here from Nigeria? In January 2012, what did our Nigerians do? Do you remember Christine Lagarde told Ngozi Okonjo-Iweala, hey, your petrol price is subsidized. Don't do that. Double the price. So what did the Nigerians do? Uprising, right? The protests that whole month. They nearly overthrew the government. It was incredible until the trade unions got in and got a bad deal. Okay, as they often do. And then you've got protests in Senegal in 2012, right, against Wade's third term. And we've got protests in Kenya. And I think in Zimbabwe you watched a film about protests. No, then you don't do that kind of thing here, right? 45 of you arrested for watching other Africans protesting. Okay, so you've got lots of protests, and they don't go down. It's tremendous. And you can look at the socioeconomic conditions. I especially like to look at protests that really work. Here's a great one, hey? Blaise is Ebola, right? Okay, this is to honor Thomas Sankara. And that was just amazing, wasn't it, last November? Wasn't that brilliant? And the protests are often over food. And, of course, that's part of our Africa Uprising story as well. And then there's labor. If you do the World Economic Forum, does anybody look at that every year? Look at even this 2014, 2015. African working classes are uprising compared to the rest of the world. Look at these slackers in Switzerland, Singapore, Denmark. These guys are just lazy little workers. They just go to work and they protest. Look at ours, South Africa, 148 out of 148 for labor cooperation. In other words, these workers across Africa are the least cooperative. This is a measure, I think, the most effective measure, because it comes from big business, of the class struggle. And Africans are winning that Olympics, right? South African workers get the gold medal. A round of applause for South African. Nobody's sympathetic to South African workers. Now, this is very impressive, isn't it? Eh? To see the working class of Africa as angry, as unhappy as that. And then there's environmental, and I'm going to turn to Khadija Sharif. She did this map for EJO, right? It's ejatlas.org, and it's a mapping of eco-social resistance across Africa. Pambazuka also ran with this. So, and then you can look at some of the protests that are mapped here by Code Africa and eNews, and look at these this is not just in the big city, these are up in the platinum belt, right, in the minerals belt. This is something that's going on all around the world, an uprising against economic injustice. And so I'll just conclude here with 3 quick slides. What do we need to see from these, let me call them popcorn protests? They pop up, they fall back down. If they had a much deeper resonance, a movement, right, like Tendai was saying, I think they might, I'm not saying this is a blueprint, that's the wrong way to do it, but I think they might argue for the exchange controls argument, lower interest rates, auditing the odious debt, controlling illicit capital flows, adopting industrial policy with import substitution and sectoral rebalancing and meeting social needs, increasing state social spending, paid for by higher corporate taxes and cross-subsidization, reorienting the infrastructure, huge infrastructure investments, but they're pro-corporate, aren't they? Those are for extractive industries. And we have so many unmet basic needs in infrastructure, and water and sanitation, the energy grid, public transport, clinics, schools, and 1 million climate jobs is the campaign in South Africa to get our workers out of that carbon-addicted, high climate change impacting activity and get a green, just transition. And I just say that if you think this is Marxist rhetoric, I'll give you two last slides, because this is the guy who turned me on to the idea of the deglobalization of capital with the globalization of people. Here's John Maynard Keynes. Tell me if I'm wrong. He was capitalism's best economist, right? Last century, he helped capitalism get out of its big fix, the Great Depression. I sympathize with those who would minimize rather than with those who would maximize economic entanglement among nations. Because ideas and knowledge and science and hospitality and travel and political solidarity, but that's not on the list, is it? Okay, he's an elite Cambridge economist. He didn't know about that. These are the things which should of their nature be international. Let goods be homespun whenever it's reasonable and conveniently possible. And above all, let finance be primarily national. That means exchange controls. He said it again, against neoliberalism. The name then was the Treasury view. And we need to manage these economies. That depends upon being free to have the interest rate and our finances under some state influence, with good states, not the one in this country and others. But to do that, capital controls is a corollary. You've got to have exchange controls. So I lay that out in a few books. I'll be happy to give you them. The brand new one about BRICS, I hope, makes the story clear that this isn't just about the Western corporates. There's some big problems, including the Yankees of Africa from South Africa, and I hope we'll be able to talk more about them. Thank you very much.